Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on economic events and their potential impacts on financial markets. Let's get started. This week's Market Insights comes with a brand new backdrop because we're covering the same old topic. I am sorry, but yes, we are once again going to talk about the Federal Reserve. But remember, the last two Market Insights were all about the long-term powers of the Fed and how they influence things. This week, the Fed actually made news. This week, the Fed actually announced a major change in their policy that will impact financial markets for years to come. And ever since they made that change, equity markets have been on a powerful uptrend, even more powerful than the weeks that preceded it. So, what did the Fed decide to do differently? Well, for most of the last 40 years, as we discussed in earlier Market Insights, the Fed has been trying to print enough money to get inflation as high as they wanted it, but no higher. And for the last 8 years, they've actually told us exactly what that inflation target was. 2%. If inflation rises above 2%, then the Federal Reserve will unprint money, which will raise interest rates, slow the economy, cool inflation, and probably crash the stock market, which typically happens when the Fed raises interest rates. Well, the big change that the Fed made is they're not going to target 2% anymore. They're going to target an average of 2%. What's the difference? All the difference in the world. Because if you're targeting 2%, then when inflation pops towards 2%, you start taking away the punch bowl, you start unprinting money, you start raising rates. But if you're going to target an average of 2%, and inflation has been running below that 2% target for a while, and by the way, it's been running below 2% for most of the last 8 years since the Fed said they wanted it at 2%. Well, that means that you don't start raising interest rates when inflation gets to 2. You can let it go above 2% for a while. As a matter of fact, if the Fed decides they want to average inflation since they started the explicit target in 2012, they could let inflation be 3% for the next 5 years before the average over that period of time increased to 2. You get why this is important. You get why the stock market has really liked this policy change, because it means that all the money that the Fed has printed and injected into financial markets, it's going to stay there longer than we thought just a week and a half ago. Now, what are the potential consequences of what the Fed's doing? Well, if they get exactly what they want, then the money's going to stay in financial markets longer. The stock market is going to love that, because you may say, well, wait a minute, 3% inflation instead of 2, won't that be bad for stocks? And our analysis of history says stocks don't really care about inflation until it gets above like 4%. As long as it's below that kind of number, then what happens to stocks as inflation goes from 1 to 2 to 3 is earnings grow a little faster, dividends grow a little bit faster, and stocks offset the incremental inflation. Not a problem for stocks. Pretty big problem for bonds, because bonds mostly yield less than 2% right now. So if inflation goes to 3%, a bond investor actually is losing money relative to the cost of living. All right? What happens if they can't get inflation above 2%? There's sort of 3 things that can happen. They get what they want. They fail to get inflation higher. That would be the Japan scenario. And if they fail to get inflation higher, well, for stocks, that's still good, because in Japan, stocks have done great. Who's it bad for? Workers, because wages have been terrible. As Japan has printed money, that's made stock prices go up, but wage growth has been bad. The economy has not been super healthy. So if you're an equity investor, that's still a pretty good scenario for you, but it's probably not the happiest scenario that could occur. And then the third outcome, they could get exactly what they want, They could fail to get inflation higher. They could get inflation higher, and then it goes higher still. You get 4%, you get 5%. You start moving towards what happened in the 70s. That's obviously the ultimate scenario where things get unhappy for everybody, because when inflation rises above that 4% threshold, stocks start doing badly, like bonds, and ultimately the Fed has to raise interest rates to get inflation back under control. With all the debt the U.S. government has taken on, with the mortgage debt that's being taken on, car debt and so forth, it's not a good environment for the interest rates to have to go up, and therefore, that's the scenario that we'll have to watch for. But the experience that we've seen around the world for the last several years is that there's a lot of money printing that can happen before we need to worry about inflation. So for right now, let's just enjoy the party. Thanks for tuning in to Market Insights. We hope you found it informative. If you would like to see more of our research, you can check out our website, caravelconcepts.com, and you can subscribe to our YouTube channel below. Thanks again.